Hello and welcome to your June Investor Update. I'm James McManus, Chief Investment Officer here at Nutmeg, and I'll be answering questions on the global inflationary outlook, the latest economic data from China, as well as giving an update on the performance of equity and bond markets in May. At a headline level, global equity markets appear to have moved little in May, but that doesn't tell the whole story given the disparity in performance between regions. While the US and Japanese equity markets posted positive returns, UK, Europe and emerging markets all saw losses. Now, the Bank of England, the US Federal Reserve and the European Central Bank all increased interest rates by a further quarter percentage point during the month, though markets remain fixated on inflation numbers and signs of how effective these policy moves are in slowing price rises. Government bonds, as always, are particularly sensitive to increases in interest rates and inflation data, with both UK and US 10-year bonds trading at higher yields during the month, meaning that their values also fell. The 10-year UK gilt yield, the amount the UK government pays to borrow money for 10 years, has actually climbed above 4% to levels we haven't seen since last summer's UK budget drama, and now higher than the US Treasury equivalent. And that suggests investors are particularly nervous about the Bank of England's next move. Well, central bank policyholders continue to hold sway over the mood of bond investors, but it's the inflationary picture and what that means for monetary policy in terms of the direction of travel for interest rates that remains top of the agenda. In the UK, the Bank of England surprised investors in May by significantly revising up its economic growth forecast, meaning it no longer expects the UK to enter into a recession this year. GDP is now expected to be flat over the first half of this year, growing to around 0.9 by the middle of 2024 and 0.7 by mid-2025. And the bank's Governor Andrew Bailey insisted in May that inflation has turned a corner, despite huge price rises in the price of food this year and broad inflation levels that are still far above the bank's target. But against that better economic growth forecast, recent inflation data has continued to unnerve bond market investors. While headline CPI fell from 10.1% in March to 8.7% in April, UK core price inflation, that's removing for the effects from food and energy, climbed from 6.2 to 6.8%. And in a bid to slow price rises, markets now expect that the Bank of England will have to raise its interest rates to between 5.25% to 5.5% from the current level of 4.5% before the end of this year. Well, mainland Europe might be slightly ahead of us on the curve, with the pace of inflation there having slowed to a level that has not been seen since before the conflict in Ukraine. The Consumer Prices Index for the Eurozone countries came in around 6.1% in May, easing from 7% in April. And core inflation in the Eurozone has slowed to 5.3%, a 4-month low. In the US, we're also seeing broad measures of inflation fall, CPI coming in at 4.9% in April, with the annual CPI rate having now fallen consistently since hitting its 40-year high, a level of 9.1% last June. Now, the chair of the Federal Reserve, Jerome Powell, has stressed that although the central bank may soon begin to pause interest rate increases, if inflation data continues to show progress, interest rates are likely to remain high as long as inflation remains at elevated levels. And it's important to remember that despite a fall in these figures, prices are still rising at a pace that's above that of central bank targets. Well, late last year, we spoke about how the easing of strict COVID restrictions had the potential to boost the prospects for the Chinese economy and emerging markets more broadly this year, given the important role that China plays in global and emerging market trade. And that economic reopening was always going to take some time after 3 years of restrictions. And so far this year, we've seen some positive green shoots in areas of the economy, particularly in the services sector. Now, one way for investors to measure economic activity in a country is through what's called a Purchasing Managers Index, or a PMI. That collates the views of key business leaders on how confident they are about growth. Now, services PMIs in China actually remain in expansion mode as consumers slowly return to their pre-lockdown consumption behaviors. But the latest results from April and May from the Chinese PMI show a different story for the manufacturing sector. There are signs there that Chinese factory activity is actually contracting against a slowing global trade environment. And that picture really also reflects what we see in Western economies, where manufacturing is weak, services sectors are strong. But unlike the US and UK, China's dependence on exports means this is going to be a greater challenge for economic growth in China. Where does that leave us? Well, resilient Western economies and falling global inflation should still help support trade, but we're going to be watching the Chinese economy very closely as the reopening progresses. We still think the opportunity for a global economic boost from the region remains, however, with the IMF recently stating that it expects Asia-Pacific nations to contribute around 65% of global economic growth in 2023. As always, thanks for watching. We'll continue to keep you updated via regular blogs, the monthly investor update, as well as the View from the Investment Desk videos. If you have any questions or suggestions for a topic you'd like us to discuss in next month's investor update, you can contact us via social media, email, or in the comments section below this video.